So taxes are going to be a really big problem. I was shocked when I saw President Biden say he's got tax items in the Build Back Better bill and in his budget that he's going to try and control inflation. It's a pretty accepted economic technique or understanding that raising taxes will increase inflation because everybody's looking for the net after tax return. So if you raise the taxes and that lowers the net after tax return, what do people do? They raise their prices to get the number they need to pay the rent, pay the employees, pay whatever. So, but of course, that's on the profit. But then you need a return on your investment. You need an income. So, and it's been proven that business owners will make sure that they make their money first and pass it along to the consumers, their customers, the at a higher price if their net is taxed higher and they can't meet their own obligations. Remember, raising the taxes takes money out of your pocket. So Biden's 2023 budget has an item that's really a backdoor tax. He's trying to push through 4-week paid family leave. So that means if you have an employee that has a birth, a death, surgery, medical issues, you're going to have to pay them for 4 weeks. Well, that's a tax on you. That's a direct tax on your net that maybe it's not going to the government, but it's going to your employees. That's a tough one. The increase in capital gains tax, I'm kind of really amazed. Hillary Clinton had it in her platform that she wanted to make um, capital gains tax the same as the maximum rate that she wanted, 39.6 on operating income. Realize in an inflationary environment, and particularly with Section 179, where you can write off the entire piece of equipment that you buy, when you depreciate it and then you go to sell it, and with inflation, like right now, used cars are an all-time high. They're at an all-time high percentage of their original value because of the chip shortage. They couldn't manufacture as many vehicles, so on. Well, when you sell one and you're going to have an automatic gain if you did a 179 deduction and it deducted the entire amount of the vehicle. And if capital gains tax goes to 39.6 and it's an operating income item, you see where this is going. It's going to take a lot of money out of your pocket and make it much more difficult for you to operate. And it's not even a real gain, it's inflation. And you need more dollars from the sale of that used item to buy the new one to keep your business going. But Mr. Biden wants to take 40% of it. That's in his Build Back Better in the budget. I don't think they'll be successful, but one needs to know what's going on out there. And that the increase in these capital gains taxes really means it's a tax on inflation. That if things go up because of inflation and the government takes a slice, what does that leave you with? I mean, the prices of the goods you want to buy to replace the item you sold is going to be substantially higher, and you're going to have a net that's substantially lower. And this has been the problem with the U.S. capital gains system anyway. The government never allows you to deduct losses. They're very limited on the losses. It's complicated to deduct capital gains loss, but they sure take their share of the gain if you gain on a piece of property. And then if it's a commercial piece of property or a piece of equipment used in a business, that when you recover any depreciation you've taken against that equipment and it goes to ordinary income and you're going to have the rate as high as 39.6, that's going to be a huge dinger on you. I don't think these things will get through. I think the Republicans will keep it from happening, but we need to think about that and see how these things cause the squeeze of needing higher prices and causing a lower activity because you're going to have less money out of the things you sell. He's also talking about moving the corporate tax rate back to 28%. This has been a platform of the Democrats probably for 12 years. Mr. Obama wanted that. The problem with that, the biggest problem with that is at 21%, our corporate tax rate is 20% lower than China's. And at 28%, our tax rate's not competitive with China. And we're going where we MBAs go. Everything's measured on an after-tax rate of return. That's why so much investment has been made in China, in India, and Bangladesh, and all these places. Indonesia has a huge amount of production because their tax rates are lower and the net return is higher when you have your products made there. But then again, there's all these other problems. But the tax bill that we had in 2017 has made it attractive, and maybe there'll be a way to keep that. And in keeping it is important because because you're going to be more competitive and have more dollars in your pocket, and that will put less pressure on the overall economy for people to raise prices. Another big dinger for small business owners is coming in this bill is there you already have the 199A deduction where you get to deduct 20% of your profits if you're a certain size. And I would imagine most of the audience that I go to here is of that certain size, and he wants to limit or get rid of it. And that will be another problem. You'll keep less of your net, meaning you're going to need more. You're going to need to raise prices. You're going to need to reduce costs. All these different things. So there's a lot to consider. But look at how important all this is. Look at how large these swings are. And it's not like this is the end of the story. There's ways to organize your business to make this work for you where the hit is smaller or non-existent. And I bring these things up so that it's front of mind so that you can get your business in a position where this just doesn't nail you come tax time.